Imagine a currency so powerful that countries around the world keep it locked in their vaults. Not because they want to spend it at home, but because without it, global trade stops working. This is a reserve currency, and for the past 80 years, one currency has dominated this role, the US dollar. But what actually makes money reserve currency? Why do central banks from Tokyo to London hold trillions of dollars they'll never spend? And what gives one nation's money this kind of global power? The answer explains how the entire world economy actually runs. Let's start with what a reserve currency actually is. A reserve currency is foreign money that governments and central banks hold in massive quantities as part of their national reserves, not to use domestically, but to function in the global economy. Think of it as the world's common trading language. When Japan wants to buy oil from Saudi Arabia, neither country uses yen or reals for the transaction. They use dollars. When Brazil needs to pay back international debt, it pays in dollars. When Vietnam wants to stabilize its currency during a crisis, it sells dollars from its reserves. The reserve currency is the money that makes international commerce possible. Here's why that matters. Without a widely accepted reserve currency, every international trade would require complex currency exchanges. Imagine a Vietnamese company buying machinery from Germany. Without a reserve currency, they'd need to convert dong to euros, navigating exchange rate fluctuations and paying conversion fees. But with a reserve currency, both countries hold dollars. The Vietnamese company pays in dollars. The German company receives dollars. Clean, simple, fast. This is why central banks hold trillions in foreign currency reserves. It's not theoretical. Japan holds over $1 trillion in reserves. China has been selling US Treasury bonds lately, so it holds less than Japan, but it still holds hundreds of billions of dollars in foreign currency reserves. The European Central Bank, the Bank of England, India's Reserve Bank, they all maintain massive dollar stockpiles. Not because they plan to use dollars at home, but because dollars are required to participate in global trade. But here's where it gets interesting. This system creates extraordinary advantages for whichever country issues the reserve currency. Let's look at what that actually means. When your currency is the global reserve, foreign demand for your money increases dramatically. Countries need dollars to trade, to hold as reserves, to price commodities. This creates constant demand for US dollars that has nothing to do with the US economy itself. And here's the mechanism. When demand for your currency stays high, your government can borrow money at much lower interest rates. Why? Because the world needs your currency, so they're willing to hold your debt instruments, your treasury bonds, at lower yields. This is sometimes called the exorbitant privilege. The United States can run larger deficits without the currency consequences that other nations would face. When most countries run big deficits, their currencies collapse. When the US runs deficits, the world still needs dollars. So demand stays strong. This doesn't mean there are no limits or consequences, but the reserve currency status provides a cushion other nations simply don't have. There's another advantage most people miss. Because global commodities are priced in dollars, oil, gold, wheat, copper, Americans effectively get cheaper imports. When you buy goods priced in your own currency, you avoid exchange rate risk. Everyone else absorbs that risk. Everyone else must first obtain dollars to buy these commodities, adding costs and complexity. Americans just use the money they already have. Now here's the historical context that explains why the dollar holds this position today. For most of the 1800s and early 1900s, the British pound sterling was the world's dominant reserve currency. Britain controlled vast trade networks, had the world's largest navy, and London was the center of global finance. Countries held pounds because Britain was the superpower and pounds were needed for international commerce. But 2 world wars devastated Britain's economy and shifted global power. In 1944, as World War II was ending, representatives from 44 nations met in Bretton Woods, New Hampshire, to create a new international monetary system. The agreement they reached made the US dollar the world's primary reserve currency, backed by gold at a fixed rate. Countries would peg their currencies to the dollar, which was convertible to gold, at $35 per ounce. Why the dollar? The United States emerged from World War II as the world's largest economy with the strongest financial system. While Europe was rebuilding from destruction, America's industrial capacity was intact and expanding. The U.S. held the majority of global gold reserves. It was the obvious choice. The gold backing ended in 1971 when President Nixon closed the gold window, but the dollar remained the dominant reserve currency. Not because of gold anymore, but because the system was already established. Countries held dollars. Trade was denominated in dollars. Changing the system would be more disruptive than maintaining it. Today, the US dollar represents about 58% of global foreign exchange reserves. The euro is second at around 20%. The Japanese yen, British pound, and Chinese yuan make up smaller portions. No currency comes close to challenging dollar dominance. But maintaining reserve currency status requires specific conditions. The issuing country needs a large, stable economy. It needs open, deep financial markets where other countries can actually buy and hold assets. It needs consistent macroeconomic policies that create trust. And critically, it needs other countries to believe the currency will hold its value. This is why, despite years of speculation, the Chinese yuan hasn't become a major reserve currency. China has the world's second-largest economy, but it maintains capital controls that limit currency convertibility. Chinese financial markets are less open than Western markets. The legal system provides less protection for foreign investors. These aren't value judgments. They're practical barriers to reserve currency status. And the mechanism that makes the whole system possible? Liquidity. A reserve currency must be easy to buy, sell, and hold in enormous quantities. U.S. Treasury bonds provide this liquidity. They're considered safe, they're easy to trade, and there are trillions of dollars worth available. This creates a self-reinforcing cycle. Countries need dollars, so they buy Treasury bonds, which finances U.S. government spending, which keeps dollar supply flowing, which maintains dollar dominance. But having the world's reserve currency comes with real downsides. Global demand keeps the currency strong, making imports cheaper but exports more expensive. And because the world needs a steady supply of reserve currency, the issuing country must send out more currency than it takes in, which in practice leads to persistent trade deficits. The United States has run these deficits consistently since the 1970s. This dynamic is what economists call the Triffin dilemma. There's also a built-in tension. Global trade requires enough dollars to circulate worldwide, but U.S. monetary policy is set for domestic conditions, not global needs. At times, the world needs more dollars than the Federal Reserve wants to create. At other times, global dollar holdings grow beyond what the U.S. economy can sustainably support. This tension has existed since the Bretton Woods system began. It contributed to the collapse of the gold standard in 1971, and it continues today as countries simultaneously complain about dollar dominance while holding trillions in dollar reserves. Why does this matter right now? Because understanding reserve currencies explains why certain countries have economic advantages others don't. It explains why the Federal Reserve's decisions affect economies from Argentina to Indonesia. It explains why countries announce plans to de-dollarize, but continue holding massive dollar reserves. The system is deeply entrenched because changing it is harder than maintaining it. A reserve currency isn't just money, it's the infrastructure of global commerce. It's the reason one nation's domestic monetary policy affects the entire world. And it's why economic power and currency power are inseparable. The country that controls the reserve currency doesn't just participate in the global economy, it shapes the rules of the game. If you found this enlightening, subscribe. We publish fresh content weekly to help you understand commerce from a historical perspective and draw parallels to modern finance, and keep the momentum going. Watch the world's first financial bubble, and why history keeps repeating itself. It's on the screen. Thanks for watching.